If we dig into Warren Buffett's portfolio, we can see that one stock dominates them all. Apple makes up 41% of Warren Buffett's stock portfolio. The second largest position is Bank of America, that makes up just 10% of the portfolio. Now, Buffett, he's not a tech guy. He normally avoids technology stocks because he always says that he cannot understand them. But there's certain qualities about Apple that makes Buffett not only buy the stock, but make it his largest position. So what I want to do in this video is do a Warren Buffett style stock analysis of Apple stock, because he said what he likes about Apple before, but I've never seen him talk about the intrinsic value of Apple or going more in depth into the numbers. So that's what I want to do in this video and actually see if Apple stock may still be a good buy today. But before we get into that, Warren Buffett, why do you like Apple stock?
I do not focus on the sales in the next quarter or the next year. I focus on they won't tell you exactly how many, but hundreds and hundreds and hundreds of millions of people who practically live their lives by it. And if you look at that little piece of whatever it is, that is some of the most valuable real estate in the world. I mean, that is, Fifth Avenue will never come close to that. I mean, it is, you've got hundreds and hundreds of millions of people with loads of buying power and able to do business or learn information or whatever it may be, and it's part of their habit of living. I mean, they spend hours a day, and it does all kinds of things for them. So that real estate is worth a fortune, and it's nice to have it added to as they sell new phones, and of course a lot of them are replacement phones, but they're adding to hundreds and hundreds of millions of consumers that are never going to get to Fifth Avenue, or they're never, and you are an indispensable part of their lives. I mean, it's an extraordinary product.
Apple, the core of their business is something that every business owner dreams of, and that is one where customers love their product, and it will take a lot for those customers to switch to another company. The iPhone makes up around 60% of total revenue. Then you have the iPad and the MacBook, which makes up around 6 and 9% of their revenue. So straight away, 3/4 of the revenue come from these three products alone. Now, I personally own both the iPhone and the MacBook, but I don't have the iPad yet. But I have no plans at all on buying another brand. I made the switch from Windows to Apple around 2 years ago, and Apple, for me and for most people, is just such a better product. They keep things simple, high quality, easy to use. I love their product, and there's millions of other people like me who think the same. As Warren Buffett says, that is a very powerful moat to have when your customers not only love your product, but they need your product. Okay, then you have wearables. That makes up 12% of total revenue. So this includes their Apple Watches, which I never got into, the AirPods and the AirTags. So yeah, the Apple Watches I never got into, but the AirPods, they are really good. I have them. They have a long battery life. They're comfortable, easy to use. I really like them. And lastly, you have their services segment, which makes up 16% of total revenue, which includes iTunes, as well as software, digital content, Apple Care, and Apple Pay. So in a nutshell, that is Apple's business model. They make beautiful, simple, but high quality, easy to use products that customers love. But just because a stock has an amazing underlying business, that does not mean that that stock is a buy. It is not that easy, because that's only one side of the formula, the business. You still need to work out if the price is reasonable, or even better than reasonable, cheap. That's the other side of the formula. In order to do so, in order to make this calculation, you need to calculate the stock's intrinsic value, look at their financials, and see if price is below intrinsic value. Let's not wait about. Let's get straight into doing just that. Now, Apple is a nice, easy stock to calculate the value on because their prior cash flows have been so consistent. So this is using the website www.buffettinvestors.com. That is a website, full disclosure, that I am a co-founder of, and you can use it to calculate the different intrinsic values of the stocks in a nice, easy, simple manner. I'm going to start by doing a normal case scenario for Apple stock. Then I'll do a bear case, then I'll do a bull case. So if we type in Apple stock and we get the right ticker symbol, and then we go onto the intrinsic value tab. So I'm going to do a 10-year analysis of this stock. We're going to project cash flows for 10 years and then discount them back to today and see what price we should be paying today, what the value is today. So this is what's called the discount cash flow method for calculating intrinsic value. This is the same method that Buffett uses. However, I will say that I'm not sure on his specific calculations and assumptions for Apple stock because he's never publicly said these assumptions and calculations or gone into them. Unfortunately, he's not great with technology, so he's never going to do a stock review on YouTube or something like that. So a 10-year analysis, that's 10 years to forecast. And also I'm going to put in my usual discount rate of 10%. I want to get at least a 10% return on my stock. Now, for the future growth rates, let's take a look at the previous growth rates, the past growth rates, so we can get a feel for what they've achieved in the past and what they may achieve into the future. So in the past 10 years, free cash flow has grown at 14.2% and 22% over the past 5 years. So we'll assume that in the future 10 years, it's going to slow down, which is generally what happens as companies get bigger. They start to mature and slow. So we'll use the 10% growth rate for the future 10 years, the next 10 years. And then we'll say that we sell the stock in 10 years time for a multiple of 14, a terminal PE of 14. I think this is pretty reasonable since the current PE is 26. So we're assuming we'll sell it for an even lower price relative to earnings. And if we press the calculate button, that is going to give us a company intrinsic value of $2.3 trillion or a per share intrinsic value of $146 a share. That means that currently Apple is selling for around fair value or perhaps slightly overpriced since their current market cap is $2.45 trillion. So the price is just slightly higher than the intrinsic value based on these growth rates and these assumptions. This is assuming that Apple continue along the path that they've been going, that their growth starts to mature, but still does decent, and the economy does fine, and they get a 10% growth rate in free cash flow over the next 10 years. So our normal case scenario, we can expect around a 10% return at the current price. That's the discount rate we used, and we got an intrinsic value of around the same price that it is today. But let me now show you the potential bear case scenario too. So the bear case is that the economy stays stagnant for the medium-term future, and Apple, iPhone, iPad, and the MacBook sales, they struggle to grow. So let's say that growth only grows by 5% over the next 10 years. Again, we're going to stay with the 10 years to forecast, and we'll stick with the 10% discount rate. However, because the economy is bad, stocks are selling for cheaper prices. So let's say that we can only sell Apple for a PE of 12. In that case, it's only worth $1.5 trillion in terms of market cap for the whole company, or per share, $94. The value in the bear case is well below the current price and the current market cap of the stock. So that's the bear case. Now we also did the normal case. Let's do a bull case scenario as well. The bull case is that Apple achieved growth rates similar to what they were in the past, around 15%. And the market, in the bull case, remains strong. So we sell our stock in 10 years, well, for a terminal PE of, let's say, 20. That is still reasonable considering the current PE is 26. In that particular case, with those assumptions, Apple stock is worth $270 a share. The value is well above their share price. So the intrinsic value of Apple really does depend on how the economy does. If the economy does well, people have money and they keep buying Apple products, then Apple will do well. And it also does depend on Apple's ability to innovate and remain at the top of the pile when it comes to tech products. If they can do so, they should justify their current share price and give investors a nice return. So the question becomes, why do I personally not own Apple? The reason is because they're just so pricey, and I feel that they've got too much to lose. They're selling for $2.4 trillion for the entire company, a share price of $150. When Warren Buffett was buying the stock, it was only $30 to $50 a share when he bought it between 2016 and 2018. So he got in at a lot cheaper price. Today, it is much more expensive. At the current price today, yes, if sales keep going well, if everything goes fine, you can get around a 10% return on the stock. But you know, the big upside, the big returns is not really there with Apple. A 10x, a 20x return is not really going to happen. So for me, I'd rather, compared to Apple, I'd rather just own an index fund and diversify my portfolio and just get a 10% return if the economy does well and everything goes fine. So for me, the big upside with Apple stock is not really there. Do they have some downside? They have a little bit, but not that much, because their core products are so good, their customers love their core products, and they're going to keep buying their core products as time goes on. I don't see the big switch being made to another device or another computer or another phone anytime soon. I think people are going to keep buying Apple products, and that's going to be fine for Apple's market cap and intrinsic value. So for me, I'd rather own an index fund than Apple, as it's more diversified and less risk. That's me. Guys, if you want to support the channel, feel free to join the Investing Academy, where you can see my portfolio. And also join the website, which is free. There's a free version which is really, really good, called BuffettInvestors.com. www.BuffettInvestors.com. I'll leave a link in the description. Join that. We've tried to make it a lot easier to use than Yahoo Finance, clicking between things. And we're trying to give important information for value investors, not so much the price swings and the technical trading things. We don't have that in the website. No, we're sticking to value investing with the website. So click that website, go on that website, and give me some feedback as well. That'd be great as well if you want to do that. Or just use the product and tell me what you think. And yes, there is an intrinsic value calculator on it, so use it yourself and you start calculating the intrinsic value of different stocks that you're interested in. Thanks for watching.